Hello, this is Henry of AutoAnalysis. Welcome to the March 2013 edition of the European Car and Light Commercial Vehicle Production Outlook briefing video. Let's start with a quick look at what happened in 2012. Well, last year we saw European production, including Russia, at just over 18 million units. This was a million units down on 2011. Without Russia, Europe was at 17 million, which is down 1.4 million. That highlights the growing importance of Russia as one of the major, if not the major, engine of growth in European vehicle production. In fact, a complete collapse in production across Europe was prevented by modest growth in the Czech Republic, Hungary, Romania, and indeed here in the UK. Plus, in Slovakia, there was a major boost in production with the start-up of the VW Up program. Major markets, namely Italy, France, Spain, and indeed Germany, all were major losers in terms of production in 2012, with German production down by over 500,000 year-on-year. The German fall was due to significant decline at Ford and Opel, and indeed model cycle effects of Mercedes and Audi in particular, plus the switch to the new Golf causing some disruption. In addition, 2011 had been an artificially good year, especially for certain brands. Looking ahead, what can we expect? Well, in our report we provide a number of scenarios, and in the best case of which we see that Germany will recover back to its 2011 level, but equally by 2017 there will be significant long-term losers evident. France will be down close to 28%, that's around 816,000 on its 2007 peak, and that even allows for us giving some credit to Renault's renewed commitment to production in France. Italy will be down by roughly the same percentage, equivalent to about 330,000 units, and Spain down by just under 20% or around 460,000 units on the 2007 levels. And that even allows for Fiat retaining some Punto production in Italy, which we had thought previously wouldn't take place, and Renault increasing production in Spain. So, major losses in the major production markets. This will be accompanied by a further eastward shift in production over the period between 2012 and 2017. We expect to see Czech production rise by nearly a fifth, Hungarian production more than double, and Romanian production go up by more than a third. And here in the UK we're still seeing a rise in production. And by 2017, if Mini, JLR and Nissan all fulfil the expectations we have of them, we can see UK production being close to, or even optimistically, over 2 million units by this time. What does this mean when we look at it graphically? Well, we can see here the rise in production across Europe, including Russia. Of particular importance is our view that by 2014, including Russia, production will be equal to what it was in 2011. Although if one takes Russia out, the picture is less positive. Russia is the dark green line and roughly in the middle of this bar chart, and you can see that it does begin to take up an increasing proportion of total European production. The reality without Russia, however, is somewhat different. The picture without Russia is certainly less attractive, and this is evident in the chart shown here. Here we first of all see that the long-term production volumes in Europe are not going to be much more than 20.5 million without Russia, well below the close to 23 million volumes, including Russia, which we saw on the previous chart. Without Russia, and even being reasonably optimistic, Europe takes until 2017 to recover to 2007 volumes. That's 1 year later than we projected last time around. The alternative scenarios shown from 2013 onwards, the various coloured lines, assume a fall of between 1 and 5% in the major markets above and beyond the falls inherent in our base outlook. However, it is likely that the decline in the European production will be both deeper and the recovery will be somewhat slower and shallower than we had earlier expected. This is shown in the chart on the screen. Number one, the increasing gap between the production in Europe with Russia total and the production in Europe without Russia total. This is shown in terms of the gap between the blue and the pink lines on the graph. And as the production in Russia increases, so does the gap between those two totals increase as well. The second thing I'd like to draw your attention to is what happens with the yellow line. This is the implications of a fall in production in 2013 and then the recovery following that, which is similar to the best case scenario in the pink line. What that shows us is it will actually take until 2016 before European production recovers to the level of 2008, and in fact it will take until well after 2017 to get back to production in 2007. Thirdly, if we have continued decline into 2014, not only will this delay the long-term recovery, but it will also risk, in our view, the market settling down at a much lower production volume, and Europe needs to consider the implications of what that means for the industry if scenarios 5 or 6 come to play, especially in scenario 6, wherein we see European production, excluding Russia, at less than 17 million units, or possibly even worse. If that were to come to pass, we simply don't believe that the current industry structure would be sustainable. What does that mean? Well, with the recent problems in terms of declining sales and resulting decline in production, and the losses that many of the major car companies are experiencing, the car companies have begun to undertake a significant degree of structural change. They're doing this because we've got the situation where the EU 27 car markets are now at a 17-year low in 2012, and it's quite probable we'll see further decline in 2013. 2007 to 2012 has seen Fiat, Ford, Opel Vauxhall, PSA and Renault lose a combined total of 3 million units production. But during that period, European production fell by rather less because Dacia, Hyundai, Kia, Volkswagen, Audi, and to some extent Nissan and JLR grew during the same period. And what this means is that we are beginning to see a new order for the vehicle manufacturers in Europe beginning to emerge. By 2017, for example, Hyundai Kia will be producing around 1 million units. It's already producing close to or a similar volume to that made by Opel, for example. In our view, the volume brands are facing long-run structural decline in Europe as the value brands and the premium marques continue to grow. And having lost around 500,000 units each over the past 6 years, we have to ask the question, can the volume brands really recover? What are these volume brands doing? What are they actually doing in terms of restructuring? Well, having lost over €1 billion each, Ford and GM and PSA, which lost even more last year, have started to close plants. Ford is closing 2 in the UK, 1 in Belgium. GM is closing a plant in Germany, but not until 2016, and PSA is closing a plant near Paris, probably next year. Fiat, by contrast, is reorganising the model allocation between its Italian factories. It's slimming down, but it's not closing its plants. Longer term, it's going to bring production back from Mexico to Poland. That's for the Fiat 500 within the next 2 years. And it's also planning to use European factories as global export bases for Fiat, for Alfa and Jeep brands. Just as we were finishing this report, Renault announced it had reached union agreement on a number of cost-cutting measures in France, and this has been accompanied by increased commitment on Renault's part to increasing French and Spanish production. To some extent, Renault is swimming against the tide, as is Fiat. GM and PSA have also come together to establish what we regard as a defensive alliance, covering logistics, purchasing and new model programs. However, the benefits are not yet apparent, although in logistics and purchasing they may come soon, but the real benefit from new models will not appear until at least 2016 or possibly 2017. There is a risk that this could be too late. Now, what happens if we see further demand and production falls? Will we need further cuts? Well, we think it remains probable that Fiat and Renault will indeed need to cut further into their fixed cost base, i.e. their network of factories. In our view, a key issue is whether export markets beyond Europe can be the saviour of European production. In recent years, certainly the German and UK premium and luxury brands have been very dependent on the US and Chinese markets for their recent growth. To date, by and large, these markets have held up, but we have to ask whether non-EU export markets can sustain European production in perpetuity, especially at the volume brands. We ask this because if we look at the VW Group, we look at PSA, we look at Fiat, BMW, Mercedes as well, they are all increasing their own production capacity outside of Europe, especially in NAFTA, Brazil and China. For example, VW is increasing production in Mexico, Audi is building a new plant in China. And some of the moves by these car companies actually seem likely to harm their struggling European operations. We have to ask how far will the new Renault Dacia production facility in Morocco, which will import vehicles back into Western Europe, impact on these brands' European factories' output. And India is actually growing as a supply point for Europe. Ford, for example, will be importing a small SUV, the EcoSport, from Europe, and this will undoubtedly increase the pressure on European production facilities. So what does all this mean? Well, in conclusion and on balance, we think that the sustained or any sustained production recovery is unlikely before 2014, and it could well be delayed until 2015. When the recovery does arrive, the revival will almost certainly be shallower and slower than the post-2008-9 collapse recovery. We think that long-run European production volumes could well be far below the 2007-8 peaks. We don't think that the implications of this have really been fully worked out by the industry. Well, if we bear in mind also that European production operations were generally not financially robust, even in the boom years, we have to ask how much longer can the major VMs continue to support their European operations if losses continue. Officially, GM appears very committed to Opel Vauxhall. Renault, undoubtedly with tacit government support, is raising investment in France. But again, are these moves really sustainable in the long term? We still expect further restructuring and capacity cutbacks. The question is when, and indeed where. We think the idea of a major European name disappearing by the end of the decade is indeed quite probable. And while this is taking place, the rising strength of the Koreans, Nissan from Japan, and the enduring appeal of Germany and the UK in terms of premium brands should not be underestimated. The pressure on the volume brands will increase, and it will be impossible to ignore. And all this will be happening without fully considering and taking into account the long-term impact of the Japanese, who are now appearing on Europe's fringe. Thank you for listening. We hope you found this briefing video of interest. Details are now on the screen telling you how you can download the report. Thank you and goodbye.